Hello trader, welcome to my channel. In this video, we're gonna break down how smart money concept works. Smart money concepts, intro to institutional trading. What is smart money concept? Smart money refers to the capital controlled by institutions who move the market, not by guessing, by strong strategy, liquidity engineering, and volume flow. Who are these institutions? Here we have the central banks, commercial banks, investment banks, hedge funds, markets. In central banks, we have like Fed, ECB, BOE. They set interest rates, drive macro moves. Commercial banks like JP Morgan, HCBC, they execute for large clients. Investment banks like Goldman Sachs, Morgan Stanley, they run hedge portfolios. We have hedge funds. The hedge funds like BlackRock, Citadel, they drive in volume positions. Then we have market makers. They provide liquidity, manipulate order flow. These institutions don't trade like you and me. They trade billions in volume every day, and their goal is to move price into an area of liquidity. Institutional volume and retail volume. Institutions, smart money traders, retailers, traders. Here, I'm gonna show you the difference between institution and retail trader, like you and me. The institution, they trade blocks of 10 million plus. They trade accumulation phases. Their volume weighted is them who create the price. Is them who manipulate the markets. They can't enter and exit like us. So we can see retail trader phase. We don't create nothing. We are manipulated by institution. We enter and exit easily in the trade. We are using RSI, moving average indicator, but institution, they don't use indicator. They're volume weighted. And we can open a trade with $10, $50, $500 per trade. But from them, they use the blocks of 10 millions plus dollars. Institutions use time, liquidity, and volume, no indicator. What is liquidity in CMC? Liquidity is fuel. It is where the market goes to collect orders, stop losses, pending buys, sells, and imbalance, file zones. Types of liquidity. We have a buy-side liquidity is above equal highs, retail sale stops. Sell-side liquidity, it is below equal lows, retail buy stops. Equal high, trap for buy-side liquidity. Equal low, trap for sell-side liquidity. So you can see here in the image, I put some example. Buy stop liquidity, sell stop liquidity, equal high and equal low. In this phase, you don't want to be caught where liquidity is taken. You want to enter once it is swept. Why smart money seeks liquidity? Before price goes to its destination, it must first collect liquidity. That is why you see fake outs, spikes, and stop ons. It is intentional, designed to trap traders, file institutional orders, then move. Why you must learn CMC? CMC gives you the mindset of a bank. Instead of reacting to the markets, you anticipate. It is manipulation phase. You trade where others get trapped. That is the edge. So thank you to watch this video. Don't forget to subscribe in my channel because next week we're gonna show lesson 1. Thank you everybody.